Enda, what is the impact of rising interest rates going to be on housing?
Paul, one of the big stories from the pandemic was a huge increase in house prices right around the world, and that was because it was so cheap to borrow money. Well, now we're starting to see something of a reversal, and it is global, and it's happening in most developed economies. House prices are coming off because central banks are increasing their own interest rates, and that's flowing through to the cost of borrowing. It's most obvious in some economies like Australia, New Zealand, and Canada, for example. Sweden also seeing a pronounced downturn, but others too seeing sharp cooling in house prices, like the UK, for example. In the US, Goldman Sachs saying probably no house price growth there next year. Now, to be clear, what we're talking about here is an unwinding of some of those pandemic gains. We're not talking about a house price crash that we saw back in 2008, at least not yet. But nonetheless, this is a crucial one for the central banks to watch. They're trying to raise interest rates and manage a soft landing, and how this housing market story plays out will be critical to all of that.
I was going to ask, Enda, isn't this exactly what policymakers wanted to see from overheated property markets that were really adding to the inflationary picture? And now that we have tightening central banks around the world, how much of this is actually a problem and how much of this is as intended by policymakers?
It is what they want, Sherry. They want to see slower growth. They want to see slower demand. If that means house prices come off, so be it. But the trick with all of this, though, is making sure it's a fairly managed decline. And at the moment, we're seeing some, a pickup in the acceleration of those declines in some markets like Canada and Australia and New Zealand, quite pronounced. Take South Korea. Policymakers there are worried about the number of people on variable rate mortgages and the exposure they have to rising interest rates. So yes, it is what policymakers want. Yes, households have high savings rates and they have equity built in from the big gains over the past few years. All of this is true, and the trajectory so far is more or less on track for policymakers. But, we're in a very uncertain, very fragile global economy right now, and I think policymakers are very aware it takes a long time for the full extent of rate hikes to play out, so they are watching this very carefully.
And of course, the end of the property sector in China is a whole different monster.
Yeah, well, that is a different story, of course. The central bank there isn't putting up the cost of mortgages. But nonetheless, it adds to the idea that the world economy is now in a synchronized global property downturn. China's is so pronounced it makes up about 20-odd% of total economic output there. We know house prices and house sales are in a slump. Few people calling it total bottom to China's real estate slump just yet. And it adds to the idea that in the past few years, say, real estate prices were adding to consumer animal spirits, adding to household net worth and all the rest of it. But now, of course, that's not happening, whether it's in China or the US or anywhere else in the world. House prices are coming off the boil.